While futures require you to maintain a large cushion of static capital just to survive intraday noise and prevent a single wick from liquidating your position, debit spreads mathematically isolate your risk from the very first second. This is exactly where a $1,000 Alpaca account becomes an incredibly efficient weapon under the Algorithmic trading infrastructure. By risking a nominal fixed cost, like the $78 in this example, you achieve total immunity to volatility without relying on hard stops, giving you a massive operating runway. With $1,000, you aren't constantly on the verge of a margin call like in futures or buying prop firm accounts. You have the oxygen needed to structure multiple positions, survive the market's natural variance, and let the statistical edge play out without panic. It is the perfect operational foundation to execute a true monthly manual compounding strategy, where risk remains flat per trade and the math works strictly in your favor throughout the month.
The dual engine philosophy. Every trader knows the frustration of being right about the market's direction, only to get stopped out by intraday volatility before the move actually happens. While my futures engine provides incredible leverage and granularity, perfect for prop firms and highly capitalized live accounts, it is inherently vulnerable to aggressive liquidity sweeps. That is exactly why I built the options translation engine. It acts as a complementary system with a completely different risk profile, specifically designed to isolate risk, ignore the noise, and grow smaller personal accounts without the anxiety of leverage. Today, we are looking at a textbook example of this dynamic from May 22nd, 2026. We're going to walk through a live trade where the futures engine took a hit, but the options engine stepped in, absorbed the volatility, and secured a massive win. The setup, the 1-hour alpha, and the futures trap. Let's set the scene. The 1-hour futures model detects a high-conviction directional move on the Dow Jones. A long signal fires. For the futures account, this means buying the micro E-mini Dow, MYM. However, as you can see in the attached trade of 8 chart, the market wasn't ready to go straight up. Intraday volatility kicked in, causing a liquidity sweep that triggered the hard stop loss on the futures position. The trade was closed out for a loss of minus $75. In a traditional setup, that's the end of the story. You took the loss and you sit on your hands. But my infrastructure doesn't stop there.
The translation engine, shifting to defined risk. The exact second that 1-hour signal fired for the Dow, the translation engine went to work. It took that high conviction alpha and routed the execution to the Dow's highly liquid ETF counterpart, DIA. Instead of fighting the chop with another leveraged futures contract, the system built a 0 DTE debit spread, specifically a bull call spread at the 506-508 strikes. Here is where the magic of the algorithm's smart order dynamics comes into play. The system doesn't just throw blind market orders and chase retail noise. The calculated cost of the spread at the time of the signal was $1. But the algorithm calculates the expected structural pullback and routes a limit order via the Alpaca API. If we look at the execution logs, long leg, DIA 506 call, filled at an average of $1.16. Short leg, DIA 508 call premium collected at 39 cents. Net spread cost, 78 cents. By waiting patiently for the price to dip into the calculated zone, the algorithm bought the spread at a 22 cents discount compared to the initial signal price. We locked in our entry at an incredible price point. Wick immunity in action. This is where the concept of wick immunity saves the day. Because we are using a debit spread, our capital is mathematically isolated. The absolute maximum risk is the cost of the spread, 78 cents per contract, $78 total. Therefore, we do not use hard stop-loss orders. While the futures contract was getting chopped up and stopped out by wicks, the option spread simply rode out the turbulence. The defined risk structure gave the 1-hour trend the breathing room it desperately needed to develop. The exit, hitting the mathematical target. Eventually, the initial 1-hour alpha proved correct. The market reversed its pullback and began to climb. The algorithm is built to protect capital and cash out efficiently. It doesn't wait around hoping for the absolute end-of-day expiration. Instead, it routes a good till canceled GTC order aiming to collect a strict 95% of the dynamic spread's total width. Looking at the DIA spread chart, entry,
78 cents at roughly 15:10 UTC, 10 a.m. The climb. The spread value steadily increases as the Dow recovers. The target. At roughly 17:40 UTC, 1:40 p.m. NY, the spread hits our mathematical target of $1.52. The Alpaca automated worker instantly executes the exit, securing the profit. We captured the core of the move and guaranteed our liquidity. Conclusion. The power of the options engine. This sequence perfectly encapsulates the ultimate goal of this infrastructure. Survive the chop. The futures trade failed due to leverage and tight stops and target too high, but the options trade won because of isolated risk and wick immunity. Automated precision. The Alpaca API handled the pullback LMT entry and the GTC profit target with 100% hands-free execution. Stress-free compounding. Because the risk is flat per trade, you can let the algorithm's statistical edge play out over the weeks with zero anxiety. At the end of the month, you simply calculate these captured spreads, increase your contract size, and let the compounding cycle continue.
The options agent comes included with your Alpaca Stocks algo.